Since its first entry in the real estate market, iBuyers have grown a lot. With iBuyers offering a technological disruption in the real estate market, real estate companies such as Opendoor, OfferPad, Redfin, and Zillow were able to make cash offers on homes much quicker through their online acquisition platforms. However, recently, iBuyers have badly misread the market, leading to a multi-million-dollar loss. Consider a family that wishes to sell their home to pursue a new career. They may have to sell their current home in order to purchase the house in the new location. And if the process takes a long time, they may rent a substandard house in the new location until their previous home gets sold, which could take more than a year. In fact, the difficulty of selling and buying a new home may force the family to abandon the new job entirely. These difficulties in homeowner-to-homeowner sales suggest the dealer intermediation is a natural role, which is where iBuyer comes in. Real quick, if you're new to this channel, welcome. And don't forget to leave a like, and please subscribe for more videos about real estate. And click the notification bell to get notified whenever we upload new videos. Sellers who want to avoid the ambiguity of not knowing if or when their home will sell can take advantage of iBuyers' quicker closing options. There's no doubt that iBuyers have offered a pleasant alternative to traditional brokerage for motivated sellers who need to move, possibly a great distance from their current location, and want a predictable sale date. Tech companies use big data to determine the price at which they think they can sell a property, which then influences their purchase bids. They frequently provide prices that are lower than those of traditional purchasers, but they entice sellers by promising quick, all-cash transactions. Sound good so far? Well, recently, Zillow, one of the leading iBuying companies, announced the end of its iBuyer service. But before we go about analyzing what went wrong, here's a comprehensive timeline of Zillow's iBuying business model. In May 2017, Zillow pilots its instant offers in Orlando and Las Vegas, allowing homeowners to receive cash offers from select investors, as well as a market appraisal from regional agents to determine how much the house would be worth on the open market. A year later, in April 2018, the company pivots to start actually buying homes, with this 4-bedroom bungalow in Arizona being the first home the company ever purchased. Around the same time, the company purchased 19 homes in the Phoenix area. According to former Zillow CEO Spencer Rascoff, at this exciting time in the real estate industry, Zillow Group is committed to developing innovative technology and services, like Zillow Offers, and with today's announcement, potential for mortgage originations that help our partners meet evolving consumer expectations, while generating more revenue opportunities. Zillow's newly formed business model received its first quarterly report 7 months later. Through Zillow Offers, the company purchased 168 homes and sold 36 homes, generating $11 million in revenue in the quarter. In February 2019, Zillow claims that the homes segment can generate $20 billion in annual revenue in 3 to 5 years by purchasing 5,000 homes per month and achieving a 33% mortgage attach rate. 2020 arrived, and the company's first quarter result revealed that the homes segment made a profit for the first time. Because of the pandemic, the company was able to sell 2,394 homes, despite only purchasing 1,479 in the first quarter. In addition, the company announces that it will resume iBuying activity in 3 markets, with Rich Barton, current Zillow CEO, confident that what he refers to as the Great Reshuffling will be beneficial to business. According to a company report, prices will return to Q4 2019 levels by Q3 2021. Despite an iBuying slowdown, Zillow recorded a revenue increase in 2021. Following the release of its fourth quarter results, the company's stock prices rises to $203 per share. Zillow also takes the bold step of putting its money where its Zestimate is, and providing customers with instant iBuying offers based on their home's Zestimate. Later that year, Zillow confirmed that its iBuying activities have been suspended due to operational capacity, labor, and material concerns. Rich Barton declares it a difficult day at Zillow by announcing the company will wind down its iBuying activities and fire 25% of its personnel during the company's Q3 results presentation. Despite making significant contributions to revenue, management cannot continue to tolerate the home segment negative impact on Zillow's bottom line. Fundamentally, we have been unable to predict future pricing of homes to a level of accuracy that makes this a safe business to be in, Rich Barton said as the home segment took an adjusted EBITDA loss of $380 million, while still having 10,000 homes on their balance sheet that they have to sell, likely at a loss. Now, other iBuying companies have recorded similar losses. According to Yipit data, Opendoor lost money on 42% of its transactions in August, with particularly severe losses in important regions like Los Angeles and Phoenix. Redfin CEO Glenn Kelman announced in a corporate blog post on Wednesday that the company has slashed 13% of its workforce and is liquidating its iBuying business. But how and why did this happen? Well, at face value, we can say that iBuying is preying over homeowners who are ignorant about the value of their home and needs to sell their home quickly. In order to persuade homeowners to sell their prized assets, iBuyers must first persuade them that they are getting a good deal. When fees and other costs are factored in, iBuyers' offers net their customers 11% less than owners who choose to sell their homes on the open market, according to a 2019 MarketWatch investigation. Not only are iBuyers' offers frequently lower than final sale prices, but their fees are frequently higher as well. Knock always charges a 6% commission when selling an existing home, but Opendoor and OfferPad charge a wide range of fees. In response to this issue, an Opendoor spokesperson pointed out that for a standard home sale, a homeowner often needs to make expensive renovations, plan numerous open houses, and wait weeks or months for an offer. This makes traditional home sales riskier. Additionally, it can take up to 90 days and don't always guarantee a price or a successful closing. Homeowners might also have to move again within that period or be stuck with a second mortgage, which isn't always an option for sellers. They also said that by selling directly to Opendoor, homeowners get a guaranteed price and timeline for their move, and they don't have to worry about the hassles of repairs, renovations, and open houses. However, the repair issue affects every customer getting ready to sell a house, which adds a degree of uncertainty to the process that the iBuyer business model claims to eliminate. Additionally, there is the matter of current market status, and whichever way you look at it, iBuyers are still vulnerable to market fluctuations. With housing prices increasing all over the United States as a result of the recent Fed's action on top of the high demand and limited supply, iBuyers, which are primarily led by Opendoor, Zillow, and OfferPad, are paying above market prices for the homes they're buying from homeowners. This also forces them to resell the homes for a higher price than ever, making it tougher for regular working people and first-time buyers to purchase homes, and therefore slowing the sales in housing market. Another limitation that the iBuying business model is subjected to is their vulnerability to significant adverse selection, which significantly limits their expansion in harder-to-value homes. When the market has slow sales, iBuyers must either accept the risk that comes with a slow market or lower their sale price to sell the house faster. In both cases, low market liquidity reduces iBuyers' profits, therefore limiting their ability to intermediate. This decreased profitability triggers adverse selection. Lower profitability as a result of holding costs forces iBuyers to offer lower purchase prices. Given the low prices, most people would rather list their homes themselves, so only the bad types sell their homes to iBuyers. This endogenous reaction forces buyers to lower their prices even further, causing the market to partially unravel. This force is demonstrated by an increase in the proportion of iBuyer purchases from bad types as market liquidity declines. Nevertheless, Evidence demonstrates that iBuyers' transaction speed and valuation accuracy over other prospective dealer intermediaries are still a significant advancement, despite the challenges in fast, remote appraisal. Contrary to iBuyers, the low-tech valuation intermediary with only balance sheet capacity would counterfactually attain a minuscule market share, which explains why intermediation in the housing market was uncommon until iBuyers' debut. In the past, there hasn't been much intermediation in the market for assets like homes because they're highly liquid, difficult to price, and have a high usage value. A few breakthroughs into the provision of intermediation services in such marketplaces have only recently been made possible by technology advances in appraisal accuracy and speed of transaction made possible by online purchase platforms. But such innovation is still not unsusceptible to market fluctuations. Tell us what you think about the iBuyer business model in the comments below. Also, if you liked the video, don't forget to give us a thumbs up. Subscribe for more content and hit the notification bell so that you can be updated whenever we upload new videos. I'll see you in the next one.